Miami. How we doing? It's great to see everybody here. I'm super excited for this conversation. We have a very special guest with us here today, Matt McIlwain. He is actually a managing director at Madrona, which is the largest venture capital firm in the Pacific Northwest. They're actually now celebrating their 30th anniversary, and he's been with them for 24 of those 30 years. And he flew in all the way from Seattle to be here with us. So let's give Matt a round of applause.
Well, you left off the most important thing, which is that I grew up in Miami and went to our Vida High School, or junior high school, and Miami Killian Senior High. So it's so awesome to be home here in Miami and share some time on stage with Pablo.
Absolutely. So Madrona just announced their latest fund, their 10th fund, $770 million, the largest fund ever raised in the history of the Pacific Northwest. And we're going to get to that. But before that, how does it feel to be back in your hometown, where it all began for you?
You know, I just love Miami, and it's amazing to see how much it's grown up. You know, when I was a kid, not a lot of people were hanging out on Miami Beach. And to see how this place, Miami Beach in particular, but Miami more generally, has transformed over the last few decades. I'm not going to quite out how old I am, but you know, it's pretty incredible. The other thing is that it was always true when I was a kid, and it's certainly true now, that there's a great combination of innovation, creativity, and kind of a free market-oriented mindset in Miami. And I think that's a lot of foundation to work with. You know, Seattle has a good bit of that, maybe not as much the free market stuff these days, but it's really incredible to see the foundation that's been built here.
Yeah, so maybe you could tell everybody here about the origin story of Madrona, because I think it's fascinating, and you know, your mentor Tom Alberg was very influential in the Seattle tech ecosystem. Maybe share a little context about Madrona's background.
You know, the cool thing about Madrona is it was started by four folks in 1995, so 30 years ago, and they had all been successful in their different career paths. Tom had been a senior executive at something called McCaw Cellular, which was sold to AT&T for $15 billion in 1994. And so they started this amazing, you know, kind of investing group. And happily for them, one of the first guys that came walking in the door was another Miami public school kid. His name was Jeff. He went to Palmetto, for those of you that know Palmetto, just down the way. And he had this crazy idea to sell books online. And Tom spent some time talking with him. They started selling books in different places. And eventually, they invested in the company. And Tom led the seed round, what we would call a pre-seed round today, in 1995. And of course, that's Amazon.com. And so, you know, Tom was on that board for 20 years. Over the years, Madrona built, you know, multi-generations of funds. I joined him in 2000. And now, as Pablo said, we just raised Fund 10, which is a $770 million fund. And what we do is we help companies from the earliest of stages build lasting and significant businesses that create incredible opportunities, not only for the people that build the company, but for the customers that they serve.
Amazing. And we were talking in the back about a little bit about the market landscape right now. Could you give us some context on where we are in the private markets and the public markets, a little overview of the market?
So I got a couple slides. We won't have to dwell too much on them. This is I wrote a piece in January on the risk-on mindset environment that we're in now. So the broader context, if you work from left to right, is that we have a lot more of a pro-growth mindset than we had even a year ago. And that's everything from, you know, the regulatory policies, notwithstanding some of this tariff stuff, and I'm not trying to, you know, kind of dismiss that, but we've got a pro-growth mindset. We've got very stable unemployment, inflation, and interest rates. And so that sets you up for a more risk-taking, lean-in environment. On top of that, a lot of companies got fit over the last few years. My good friend Brad Gerstner famously wrote this note to Mark Zuckerberg about getting fit in late 2022. Well, Mark took that to heart, and you look at the companies and not only the economic value growth of those companies, but the cash generation of those companies, and that's true from a public markets and a private markets perspective. That then also leads to the other two, because you kind of work across to the far right side, that there's a growing demand for buy side, i.e. companies buying other companies. You saw Google just, offer, and we'll see if the regulators let it go through, but to buy Wiz for $32 billion. What's notable about the buy side has been the reemergence of strategic buyers. So, and not just the big companies like Google, but also companies like the Databricks of the world. ServiceNow just bought a company called MoveWorks. There's a whole bunch of these companies that are being bought by strategics, whereas for the last couple of years, you were primarily seeing acquisitions by what we call financial sponsors. The Vistas, Thoma Bravos, the Blackstones of the world. And then there's a whole bunch of reasons why sell side's happening too.
Absolutely. So you've been on the Forbes Midas list 3 times. Madrona has backed some legendary companies like Rover, Redfin, Smartsheet early on, which just got acquired for $8 billion. What is it that you look for in these entrepreneurs? And like, what is it that stands out that makes you guys want to write them a check?
Well, let's maybe skip ahead a little bit. We'll come back. Well, maybe let's just touch, one more thing let's touch on here, if I can get this back. First of all, we're pretty lucky to be in Seattle, this place from. I think Miami, and let's look at this slide for a second. On the left-hand side, you've got the 6 largest technology companies in the world. They also happen to be the 6 largest companies in the world. 10 years ago, 11 years ago, when Satya Nadella became CEO of Microsoft, and we just had Satya at our annual meeting last week talking about the story and the journey of what's happened at Microsoft, those 6 companies combined were worth $2 trillion. That's a heck of a lot of money. But if you see the longer bars for every single one of them, those 6 companies today are worth 16 trillion. Okay, today maybe it's 15.5, but it's kind of 15.5 to 16 trillion. That's $14 trillion of value creation in the last 10 years. What if just one company in Miami over the next 10 years could create $1 trillion of value creation?
Who's going to build it?
Who's going to do it? Because it would be, there we got it. Good, I love it. I love it. So the other thing that's important is there's a ton of cash generation that's happening on the right-hand side here too. And so this is back to my point about, the buyers have got the cash and they've got the wherewithal, whether it's with their currency, i.e. their equity, or their cash itself. So we're at the opposite other end of where that world starts in terms of building companies. And now we can kind of click ahead here. This is a graphic that we use when people ask us, what are you looking for? Just like Pablo did, in a company. So let's start at the top of the triangle. If somebody comes in and is telling me that they're obsessed about some problem they're trying to solve, that gets my attention. And they go on and on about this problem, why it exists, why it's hard to solve, maybe why it wasn't as big a problem before, but now it's a bigger problem. Then I can see the passion in their eyes about the problem they're trying to solve. Then you go down onto the lower right side of the triangle, and you've got this question, which is like, why now? Why now can this problem be solved better than it could ever be solved before? And sometimes that's technological, sometimes that's societal, sometimes that's business model. I would argue that one of Google's most important innovations, they kind of ripped it off from somebody else, but don't matter about that. They took a business model innovation, next best search result and the economics around that to build their business, the actual monetization of Google. And then there's the why this question. What's the solution? And usually the solution is directionally correct and specifically wrong at the beginning. And so at the end of the day, it's about the question in the middle of the triangle, which is the founders that say, why us? Why are we the people that are going to figure out this triangle and build the solution and ultimately the company that's going to change the world? And that's what we're really looking for, is that spirit and that belief and that drive and that curiosity that's going to be somebody who can actually deliver on the why us.
Amazing. In preparation for this conversation, I actually spoke with your partner, Jerry Grinstein, who's former CEO of Delta Airlines. And one of the things that he told me is that when you joined the firm, he was actually skeptical because you came from a consulting background, but that very quickly he realized, and it became clear to everybody at the firm, that you were going to be the next person to lead the firm. And that was for 2 reasons. One, you were really great at adapting and adjusting as the markets did, cloud, now in AI. And 2, you were able to communicate that vision better than anybody else could at the firm. Now, as a firm, you guys had to adapt, but as we all know, startups are rarely a straight line, and they have to adapt constantly. So could you share a little bit of, maybe if you have some stories of like some of the startups that you worked with that had these multi-billion-dollar outcomes? On the surface, it seems like it was all fine and dandy, but doesn't always play out that way.
No, we can kind of go back a couple slides here. Okay, well, let's take a look at this slide. This is a bunch of companies that we've invested in over the years. And you can see in the middle, those 5 arrows, those are the major technology disruption trends that have happened over the last 30 years. And so to your point about what's changed all the time, I think I shared this story with some folks yesterday. Take a company like Smartsheet, which was in a couple of our funds, as it turned out. This was a company that was building a cloud collaboration tool. And this was just as the cloud was becoming a thing, 2007, 2008. By the way, cloud as a concept had failed multiple times. IBM had something called grid computing in the 1990s, too early technologically. It wasn't until a technology called virtualization, VMware popularized that you even could dream of creating a true cloud computing platform. Amazon figured that out, got it right first with AWS. Smartsheet was one of the first companies featured on AWS, but the reality is that they struggled initially around the mobile front end that was also becoming a thing just after the cloud was becoming a thing. And so the company almost went out of business. And so we had to work together with them to say, okay, let's double down on a reimagined front end. This is also when Facebook and others for their own consumer-facing things were dealing with that. And have a resilient belief that this was a company, this was a team. They were passionate, in terms of the why us, that they could iterate on that model and figure it out. And that company today, $1.3 billion in revenue. They have customers that pay them millions of dollars a year as a kind of a company that started bottoms up. Learned the way. I remember in 2011 having survived through the financial crisis, almost gone out of business a couple times. We were sitting with the Smartsheet guys, and one of my partners said, "Hey, what would happen if you all hired one inside sales rep?" And they're like, we've been talking about that too. Maybe we'll give it a try. They hired that one inside sales rep, and they grew to ultimately having hundreds of inside sales reps and doing it in a systematic way. Andrew Bennett was the guy in charge of a lot of that, and some other members of that team. So there's this resilience, but then there's also this ability to kind of deal with the realities of the technological changes. Now, of course, the big technological change that's happening now, let's see if we can find the chart I'm looking for. Here we are. We don't want that one. Let's go to this one. Okay. So 5 years ago, we started something called the Intelligent Application Top 40, IA40. Mind you, this is when models were becoming a thing, and everybody thought the model companies were going to be the big winners. That's not to say that Anthropic and OpenAI aren't going to be big winners, but our belief is that primarily the value in AI is going to be captured at the application layer and in the enabling technologies that enable the application layer to be built. Remember, this was 5 years ago. And so this list is a list that gets voted on, nominated and voted on by all the best VCs, all the biggest technology companies in the world. And then we use PitchBook data and we combine it with some algorithms and we come out with this top 40 companies, private companies in applied AI. Those 4 companies you see that are circled there, those are the only 4 companies that have been on the list every year, which highlights both the opportunity and the disruption that's happening in applied AI and the danger and the risk of durability in applied AI, because it is very hard to stay durably on top in that environment.
Absolutely. And speaking about AI, you guys were early to AI. Many investors will say they're early, so maybe you can share some context on how early you guys were. And also, there's so much happening, so much activity, and it's all accelerating so rapidly right now. Are we in a bubble like the dot-com boom, or is this a very unique technological shift that's happening, once in a generation type of shift?
So, we were a little bit fortunate again. Microsofts and Amazons of the world were using a lot of machine learning, as we generally talked about it back, 15 years ago. And then there were great research institutions in our region, University of Washington Computer Science School, the Paul Allen School of Computer Science, the Allen Institute for AI. And so we were ahead of the curve in this area. And so companies like Turi that got bought by Apple and Octo AI that got bought last year by NVIDIA were some of the early bets we made many years ago and kind of gave us the sense of just how disruptive the world of applied AI was going to be. And that's turning out to be correct. Now, there's lots of different companies that are going to be successful in this space, but and you're looking at a whole bunch of them right now. What's interesting about this is last year's list. This year's list will come out in September. I'm pretty willing to bet that half these companies won't be on the list this year. Now, there's some big success stories in here. Companies like 11 Labs and Writer. Wiz just got bought for $32 billion. Glean's doing incredibly well. You could go down. There's a whole bunch of these that are really great. But the list is very dynamic, and it's especially dynamic in terms of the early and the mid-stage categories. What's going to make the difference? I think it's an underhyped space. Now, that doesn't mean there's going to be a lot of losers, but applied AI is so transformative, and here's a big reason why. We're going from a world where we had structured data and structured workflows. That's what we call SaaS. They were cloud accessible, but they were structured. And now we have all this unstructured data. It'd be kind of like going to the Midwest into farmland and thinking, well, the farmland can give us some crops, and that's good. But underneath the farmland, there turns out to be, fracking that enables all kinds of other, kind of energy sources. And the energy is even better. Well, unstructured data is like that. Unstructured data was stuff you stored in backup. And now that unstructured data can be unlocked to train models, not only general purpose models like a kind of a ChatGPT, but domain-specific models that I can build some kind of a marketing app or insurance tech app or fintech app to do something that's not only built originally differentiated, but then has now got a continuous feedback loop, because the more I deliver value to the customers, the more I get what's known as reinforcement learning of different kinds that I can incorporate back into continuously making my model better. So we think that the technologies are there to be incredibly disruptive. However, we also think that the most important AI model is the business model. And the business models are changing dramatically, and it's not at all clear what the winning business models are ultimately going to be. I have a hunch that there's going to be some combinations of sort of flat fee. This is on the enterprise side, sort of like a flat retainer kind of fee level with a consumption regulator. So a little bit like what Databricks and Snowflake have moved to in terms of their business models, but moving that more up the stack from infrastructure into applications. And then we could talk about the consumer side too, if people are interested, because I think there's some even bigger disruptions there.
Absolutely, yeah. You guys invested early in this company called Read AI.
Yep.
You guys actually helped incubate the company and also incubated Rover.
Yep.
Rover, $2.3 billion exit about a year ago. Read AI, in just a matter of a couple of years, is now worth $450 million. Maybe you could talk a little bit about how you find these founders, how you incubate these companies, and maybe some lessons learned from helping build these companies over the years.
Well, we have a mindset that we want to take a first meeting with any entrepreneur, right? That that we know and has gotten connected to us, and our view is that it's our job to add value to your time with us. Like if you don't walk away thinking, God, I got something out of that, then we have failed, because we also know. I mean, we keep the stats. We're going to back 1 out of 100 companies that we follow. And maybe 1 out of 25 companies that we actually meet with, and so it's really low odds, and that's true for any venture firm. I don't think our numbers are all that different. So we better add value in every one of those meetings. But sometimes you just find this compelling team. I talked about that triangle before, and this kind of this notion of the why us. The why us is about something we call founder market fit, because I could never build a great robotics company. But maybe I could have built another successful company in my earlier life. But so I'm looking for, why are you the ones that are going to go build the solution to this particular problem? And then there's a set of general purpose attributes that we look for. And so it really starts with curiosity. We were talking about that. I mean, authentic curiosity is an act of I don't know. I genuinely don't know, not like I sort of false like I don't know. And I'm willing to learn. And if you start things with a strongly held convictions, or strongly believed convictions that are loosely held, you have a chance of continuous learning. So think about a circle, and there's this curiosity loop, and you go from curiosity into triangulation. Why triangulation? Because you're going to get a lot of different points of views if you're genuinely curious, and you need to be able to triangulate those points of views in order to ultimately be able to then make a decision. And then you got to make decisions. At Amazon, they have this expression about people that are being right a lot. And that's a cool expression, which basically means when you make decisions, they're right more often than not. But even the best people are only right 60% of the time. And so the key is to be willing to make decisions, get new data, and learn from it. Because most decisions are two-way doors, not one-way doors. I can make a decision, I can walk through the door. If I'm wrong about that, I can walk back out the door. And so there's only those handful of consequential things that are actually one-way door decisions. You better spend a little more time, get a little more data, have a little more debate before you make those decisions. But most decisions are two-way doors. And then you make those decisions, you get the feedback, and you're back around again. So we're looking for a set of signals that can suggest to us that this founding team has those kinds of attributes in order to back them.
Absolutely. And we've got about 3 minutes here, but so to wrap up, at OneSixOne Ventures, we really focus on building ecosystems through events, helping founders connect with resources like mentors, investors, customers. And, we're really bullish on the Miami ecosystem. We've got some great founders in the room today. We've got some great investors in the room today. What is an actionable step that people in this room can take to help grow the ecosystem and to continue to move their companies forward?
Well, I'll go back a little bit because I think we can put the answer to this question in the context of the venture market. So you mentioned we just raised a $770 million. It is our largest fund. It's probably about, in my opinion, as large as we should ever be. And there's two strategies. One is for like pre-seed to A fund, rounds, and then kind of Series B, Cs that are new to us. But where does that put us in this chart? That puts us as the 15th largest fund raised last year, in the context of 70 billion of total capital being committed to venture funds. The interesting thing is the top 15 represent 60% of the capital. The top 15. There were 450 funds raised last year. The bottom 90% represented less than 30% of the capital. So capital is not the differentiation, and this gets to your question, which is we've always had a mindset, you guys clearly have this mindset, it's one of the things I love about you, of the bigger pie theory. If people are focused on building the bigger pie, there's going to be plenty of that pie for them. And so how do you create a bigger pie theory versus the alternative point of view is divide the pie theory? How am I going to slice up the pie and make sure I get my piece? Focus on the bigger pie mindset. And with that bigger pie mindset, you're going to be able to say, okay, look, we're going to host events. Like we have, I'll give you an example. In a couple weeks, we're having a general counsel summit. Now that may sound boring to you and me, but there are 350 general counsels, the chief lawyer of companies, small companies, medium-sized companies, super big companies. Last year, the general counsel from OpenAI came and spoke off the record at this event about the drama of when Sam got fired. It was fascinating. It was amazing. And we opened it up to everybody. It wasn't just for Madrona general counsels. It was for the ecosystem's general counsels. And we do that with CFO events. We do that with chief marketing officers, et cetera, et cetera. And similarly in Seattle, we host different events and we want to bring the community together. If you're much more focused on being the center of the hub, you're kind of missing what you want to do is you want to be a catalyst for the things that are going on at the edge of the wheel. And not worry too much about the role you're playing at the center. You can maybe kind of inspire stuff. And so to your specific question, I think it's getting out there and trying to say, can I help, just like I said, like a first meeting. If I can't help a founder in a first meeting, I have failed at that meeting. And that's a really great mindset. Take the time, I know you don't have infinite time, to go meet with one other person, try to figure out how you can help them today.
Find somebody you can help. Let's make the pies bigger. Everybody give it up for Matt.
Thanks for having me. Great to be back in Miami.
Hopefully we can get him to move to Miami soon.